Good evening, guys. Welcome back to today's class. All right, so today we are going to see MCQ. Hope you guys are watching this series, and I just wanted to tell you that there is some discounts going on. So can you use that code and you can avail those discounts, and then you can get benefited out of it. All right, let us go to our class today. Let me connect to the chat box. Just a minute. All right, done. Thank you. 1 minute, guys. I'm just connecting. Yes, I just connected, so we'll see now. All right. So today we are going to see MCQs. Okay. Now, last week we solved few questions, right? So I think one of the session was due to poor network. We couldn't continue. So I hope you would have seen that recorded sessions. All right. So now again to further continue the MCQs, I have given few other questions where we can understand few concepts via MCQs. Okay. All right. Now we'll go through that. First one. Which one of the following is not a measurement base as per framework? Guys, there is a chapter, there is a portion in your syllabus which talks about the accounting framework, accounting information system, or how to prepare your financial statements. So that is called framework. See, it is not that just if you have studied in your graduation or in your school, it is not like that. All right, those are all very basic stuffs, but to prepare your financials, Companies Act has said, laid down, or it has told certain things that how you have to prepare and what it will come, where it will come, what are the items it will be, and how you have to measure those items, how you have to present those items. So all those things that has been mentioned. So that set of things that is called as framework. We call that as what? Framework. Even Companies Act only told that we have to follow which one? Accounting standard. So accounting standard laid down certain rules for each and every item, how you have to report it in your books. Correct. So now, as per the framework, what are all the measurement bases? Ma'am, why, first of all, why we need this? Guys, understand. In your financial statement or in your business, you have lot of transactions going on. Correct. See, as a reader of the financial statement or as an investor, I should understand certain things. Correct. Now, when I read your financial statement or your financial statement is nothing but it is your report card. Correct. So when I read, suppose there is something called assets called building, land, machineries, inventories. Correct. So now I should know how that has been valued. Correct. No, you can't put whatever value you feel like. No, right? So there should be something specific. The law has told that. No, 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 no. You cannot put however you want. You cannot value however you want. There are certain things which you have to, suppose, say, for example, I'll tell you, there is ESOP. All right, so, that is employee stock option scheme, stock option scheme. Nowadays, it is very popular because of startup culture. All right, ESOP. So the standard tells very clearly, when you account to the ESOP, you have to take the fair value, right? To arrive that fair value, there are various methods there. All right. In that also they have told you, no, you have to use, present value or discounting cash flow method, Black-Scholes. So it has been mentioned in the standard. It has been mentioned in the act itself. You are getting it. So please remember, it is not that you can use whatever values you want in your financial statement. You can give whatever figures you feel like. No, you can't do that. If I say another classic example, I'll tell you. When we talk about AS11, that is your foreign exchange translations, in that they have mentioned if it is a non-monetary item, you have to carry that, you have to value that at a historical cost unless it is revalued. Suppose revaluation happened, then on that revaluation date ka rate you can convert. Otherwise, you have to carry that particular non-monetary item and under the historical cost rate that they have mentioned it. You are getting it. So now the question here is, so framework has mentioned certain basis. So what are all those bases that has been mentioned in the framework? Framework has given 4 bases for that: historical cost, present value, current cost, and realizable value. Future value is not there. You cannot do it in, in future it will be like that, so I'll be valuing now. The cash flow would be like that, so I'm doing it like this. No, nothing of that sort. We have 4 bases. We have 4 methods where you can measure your transactions, any for anything for that matter, because they have certain things. Revenue, they have given how you have to value. ESOP, how you have to value. Forex translation, how you which method you have to follow. Inventory, they have given. Assets, they have given. So it is like that. Assets to PPE. I'm talking about PPE. Are getting it? So now there are historical cost, present value, current cost, and when you have to use this realizable value. Suppose the company is not a going concern, which means that the company is going to shut down in near future. There is no foreseeable growth, or there is no foreseeable survival of that company in the near future. So then the company is going to wind up, or not wind up exactly. The company is going to, it is slowly sinking. Now you know that, okay, the company is dying now. It's not gonna, it is not gonna come, it is not gonna continue. So going concern itself is a question there. Now the principle clearly told, accounting principle is clearly mentioned. If the company is not an idea of going concern, then you have to prepare your financial statement based on, realizable value. You cannot prepare it on, as if it is a no. If it is not a going concern, then you have to prepare it on what value? Realizable value. So what is meant by realizable value there? You're getting realizable value means, if at all right now, if I discard this particular item, how much I will get? You're getting it? So everything will be like that. So all my balance sheet items will be portrayed in the realizable model. You're getting it? All my assets will not reflect in the historical cost. You take one company which is very good, it will be there for another 10 years. There is no unfortunate events gonna happen in the near future. Then they will be doing it in the historical cost. Whereas the company is already in sinking mode. The company is not gonna be in existence for in another year. In 6 months, it's going to be fully shut down, closed down. The company is dying. Then in that case, they will not prepare the financials as they have prepared earlier. They will prepare the financials based on realizable value. You're getting it? So that from where these people are coming up with this, because framework has told that, and framework has clearly mentioned what is meant by realizable value. You're getting it? And current cost. Current cost means right now, if I purchase that particular thing, what would have been? Suppose I have a machinery. All right, I purchased this machinery 5 years back, say for example, for 1 lakh rupees. Now my situation is telling me that to value that at a current cost. Now what will I do? I will go and check what would be the cost of that machinery now. So now if it is, say for example, 2 lakhs, so then I have to value in that fashion. You're getting it? So like that, your framework is nothing but your guidelines, accounting guidelines. It is set by Companies Act. It is set by accounting standards. So there, how many measurement bases they have given? 4 measurement bases they have given: historical cost, PV, current cost, and realizable value. You're getting it? So the question here is, which is not a thing. So which is not as future value is not the measurement base. You cannot do that. You're getting it? Next one, cash flow statement is not mandatory for. Again, this question related to your, applicability of accounting standard. Remember, though you would have studied cash flow statement as a cash flow. What does it mean, ma'am? Cash flow to cash flow? No. What I'm saying is cash flow is also one of the accounting standards, AS3. All right, AS3 deals with cash flow statement. But in your syllabus, they didn't give it as an accounting standard, but they gave it that as a topic. That's it. All right. So that's the reason I wouldn't have taken it as a accounting standard. Accounting standard, though, then I would have talked for whom it is applicable. For whom and all it is not applicable, which format they have to follow, this company has to follow. If this is the, if it is a banking company, if it is an insurance company, how it has to be prepared. So accounting standard has wide varieties. You're getting it. So since your syllabus didn't talk cash flow statement as an accounting standard perspective, I didn't tell all those things. But for safer side, I'm just giving this because even in Companies Act, why I'm stressing on here is not on funds flow is, remember, financial statement means what? It has four things. One is, first one, balance sheet. Second one is your statement of P&L. Third one would be cash flow. All right. So third one would be cash flow. Fourth one would be notes and explanatory, other significant accounting policies and explanatory notes, schedules. All right. So now when I say financials, it is four items put together is called financial statement, ma'am. But you are saying cash flow is not mandatory. So is that possible? Yes, it is possible. Because Companies Act also have told that, accounting standard was also told that cash flow statement is not mandatory for few guys. So what they said is, fine, these guys are small people. These guys are small. Why we want to trouble them with this, cash flow statement and all those things? Let us not do it. So they gave some relaxation. These guys are very small, so we'll give them some relaxations. So to whom they gave the relaxation is three people. One is one-person company. Second is dormant company. Third one is small company. You're getting it? Again, ma'am, what is meant by one person, dormant and small? I request you to go through your accounting notes, which we have given. There also I have explained. And even in the Companies Act also, I have explained what is meant by OPC, dormant and a small company. You're getting it? So for these three guys, they have given an exemption saying that you guys no need to prepare the cash flow statement, which is part of your financial statement. You no need to prepare. You just give only balance sheet, P&L and other notes to accounts. That's it. That is more than sufficient. So now your question is, cash flow statement is not mandatory for whom? Your options there are OPC, dormant, listed. So out of that, OPC and dormant is the answer. So both A and B would be your answer. Why I've given this type of question is so that you can cover maximum, areas. So instead, I don't give like OPC, listed and public company, private company. In that, you will be ending up only with OPC. So if I give dormant, so you have covered the maximum stuff. All right, that's the reason. So OPC, dormant and small company, for these three guys, cash flow statement is not mandatory. Okay. Next one. This question is related to your rights issue. All right. And this question is, related to journal entry. Here you can connect with both the stuff. One is rights issue is one of your topic. And second one is basics of your issue of share capital. I think there is one topic which is very much basics, like, how the share, what would be the entry for if I issue a share capital. If I issue the share capital at a premium, how much it would, how you will pass the entry. If I issue a shares at a discount you should not do, but still, if you issue a shares at a discount, what will happen? If there is a calls, but the calls were not paid, what is meant by calls in arrears, calls in advance, forfeited. So all those things were there, and all those things have been given in your notes also again. So now this question is related to that. All right. Now the question here is, when the right shares are issued at rupees 12, face value is 10 and a market MPS is 15. All right, now what will happen here? Guys, remember, remember. Now this question, ma'am, what they are asking here. Now here I will go with the answer, then I will understand, okay, what they are talking about. Now if you see all the 5 options here, you can see that share capital, they are talking only about the account called share capital. So which means now my focus is on the journal entry. Now what will I pass? Now they are issuing at 12 rupees to me. Ma'am, MPS they have given, that is simply unwanted information they have given just to confuse you. You are getting it. Now my only thing where I have to fix is, what is the face value? 10. What is the issue price? 12. Now what is it? Is it issued at a premium or issued at par, or what is it? It is issued at a premium. So whenever shares are issued at a premium, then what should be your entry? I know issue of share capital, issue of shares. What would be the entry? Bank will be receiving the money. I'm just skipping all those step entries, guys. I'm just doing the straight impact entries. So bank will be receiving the money. So bank account debit. To share capital account, because shareholders are giving that money. So to share capital account, right? So bank, how much they will receive? Shareholders will be paying us 12 rupees, correct? So I will park 12. Share capital, we know that always it will hit with which value? Face value. You cannot charge share capital with any other value. Whether you issue at a discount or whether you issue at premium, doesn't matter. You have to hit the share capital account only with the face value. So now I will put 10 rupees. Ma'am, now this is not mapping. No, ma'am, there is some debits and credit mismatch. No, then what will you do? Then what I will do is, now there comes one more account called what? Securities premium account, because I will create a reserve now. This is one of my reserve now, because 2 rupees extra I received from the shareholders. Now this is my capital receipt. Correct, na? Capital, this I have explained in the very basic classes. So securities premium is your capital receipt. So it will be credited. So 2 rupees I will put. So now debits and credit matched. So this should be the entry. Now, ma'am, then why MPS? Again, this is unwanted information just to confuse you. So please remember, whenever they are talking about issue of shares, whether it is bonus, whether it is right shares, whatever it is, you just fix your, concentration only on face value and the issue price. Remember, all right? So the comparison should be always with the face value and the issue price. Market price is not relevant to me in case of right shares. Where I have to be careful with the market prices in ratio analysis and in the ESOP. You're getting it? So only in those two cases, market price is important for me. All right. Other than that, right shares, bonus shares, so there is no way for all these things. But because no cash impact will be there in bonus shares, and basics like other share, normal issue of shares, share for feature, share issue, calls in advance, everywhere you have to look at only two things: face value and the issue price. No need to worry about your market. Now market value. Now coming back to your question. Now here what the options they have given, they are talking about share capital. Now tell me, share capital is, what happened to the share capital? It has been credited first thing. So now I will be looking at only the credited options. So these two options has been ruled out. All right. Now three options are in front of me. All right. Now what will I do? Share capital will be credited with how much value? 10 rupees. Always it will be credited. Share capital. Even in buyback also, remember, whenever you are buying back your shares, all right, whenever you buy back or whenever you are reduction, whatever you do, all right, whatever you do with your shares, the share capital account will be impacted only to the extent of face value, not more than that or less than that, nothing. Share capital account will be impacted only to the extent of face value. Now the face value is how much? 10. So the answer should be C. You are getting it? Next question. My market price is 160. ESOP price is 60. Vesting period is 4. Then P&L will be dash every year. Remember, this question related to your ESOP. All right. Now, when I talk about ESOP, there is something called intrinsic value we will find out, and that will be as per the provisions of ESOP. What it says is the difference between, all right, the market price and the issue price, all right, ESOP price and the difference between the market price and the ESOP price, that is excess of ESOP price over the market price, that will be amortized over the vesting period. All right, that will be amortized over the vesting period, and that will be captured in your P&L. Guys, understand what happens here is, ma'am, first let me explain few things who are very novice to this ESOP things. Let me explain that. See guys, what happens? Suppose I am Infosys, okay? Now Infosys shares are traded at say 5,000 rupees per share in the market. Now what company is telling? Baba, you are my employee. You have done a very good job. So I am going to give you my shares. All right, I'm going to give you my shares at rupees 2,000. Guys, remember, the company is giving you shares at what? 2,000. If the company is rising, you have to pay 2,000 rupees to the company, and they will be giving you the shares. Correct? Now company will be collecting how much? 2,000. But at the same time, if the company goes to the market, how much they can collect? Obviously 5,000 rupees they can collect now if they go to the market. Open, I'm asking about FPO. If they go to FPO, they can collect obviously 5,000. Now what happens? The company is giving that, instead of collecting 5,000 from the people, they are collecting only 2,000 from their employees, because they are just, giving us a discount. All right, not as a, I mean, if I want to put it in very local language, it is like a discount. Baba, you are my employee. I'm giving you some favor. You're getting it. If I go outside, I'm getting 5. That's fine. I'm ready to lose that 3,000 rupees for you. So understand that 3,000 is the cost for the company or not. That is what accounting standard is saying. AS 15, what it says is that will be treated as cost to the company. That 3,000 rupees what company is forgoing. All right, if they go and give it in the market, they will get 5,000. They can raise funds at 5,000, but they are giving it to their employees on 2,000 rupees, which means they are ready to forgo 3,000 rupees on behalf of their employees. Okay, so now they are losing that, right? So that will be treated as employee cost, right? So now what they're saying that now, okay, if 3,000 rupees is an employee cost, now that has to be captured in my P&L. Yes, I will capture it. Fine. So till that you understand. So now what happens? 160 rupees worth of share the company is giving for 60, though 100 rupees is how much? 100 rupees is the total cost to the company. They are forgoing. Correct. The company is forgoing. Understood. 100 rupees to be recognized in their books as an employee cost, as an expense. Done. Now what they say, would you charge this entire 100 at one shot? Suppose if the vesting is happening on the same year, that year itself, I declared it today, I grant the, offer today, I grant the offer today, I grant the options today, and today only if it is vesting. Vesting means the employee can claim, the employee can exercise this offer. The employee immediately pay 2,000 rupees, they will take the shares. So that is called exercise. All right. So if the employee can immediately exercise this option, so then the vesting, there is no vesting period, because today I granted the option and the employee is doing it. All right. But what happens usually, the companies will say, Baba, I'm giving you this, but make sure that you are eligible to get this only after 3 years or only after 4 years, which means you have to serve me for 4 years. Then only you are eligible to get my shares at the rate of 60 rupees. So that condition they are putting, no. So the time period between the issue grant of option and the exercise, then that would be, and the conditions to be satisfied for exercising, that would be treated as vesting period. All right. Now what they say, if there is any vesting period, all right, then accounting standard says that then the total cost should be amortized over the vesting period. So now the total cost here is 100 and divided by 4. What is the vesting period? How many years vesting period? 4. So each year I will be charging my P&L 25 rupees. Now charging my P&L would be means what? I will be debiting my P&L 25 rupees. So the answer is A. All right. Next one. Now, this is regarding your, again, financial statement. There is one topic in your syllabus which talks about, framework, financial statements, and how you will prepare and all those things. So there, one of the concept is equation. All right. So equation, always there is an equation for your balance sheet. That is nothing but assets is equal to liabilities plus capital. All right. Liabilities plus equity or liabilities plus capital. All right. This is the formula. Now, any balance sheet you take, any financial statement you take, your balance sheet will be comprised of only this. Guys, understand, this is this I think I have explained in my previous lectures also, even in my basic videos also I have explained. Remember, if you have a house, your house is total cost of this house is 50 lakhs. Now you are saying, I am owner of 50 lakh worth of house. Now they'll ask you, is it fully financed by your own end or have you gone for loan? You will say, no, I have gone for loan of say 30 lakhs and I have given 20 lakhs. Now what does it mean? Your liability is 30 lakh and your own contribution equity is 20 lakhs. So these two put together will be equal to your asset. Correct? No, whatever you are worth it today, either it would be your own contribution, your own earnings, all right, or your own savings, whatever it is, or you would have borrowed and you would have done. If I own a car, simple. When I can do only these two things. Guys, why I'm saying is all the assets I'm saying, whatever it is, guys. Whether you are purchasing gold, whether you are purchasing jewelry, you are purchasing anything for that matter. There could be only two explanations, either two sources. Either it would be from your savings or from your own money, or you would have borrowed and you would have done. Correct, na? So when it is from your own pocket, it is called equity. When you borrow and do, it is called liability. So that's the same thing applies to your business also. Whatever the assets I am owning, the business is owning, it could be only from two sources. One is out of the equity, the capital what they raised out of their own contribution, company contribution. And the second one is they borrowed. You're getting it. So now this is the equation. All right. Now the question we will see. Asset is equal to 5 lakh. Capital is 2 lakh. So 5 lakh is equal to liability, I don't know. And equity is 2 lakh. Now liability is what? 5 minus 2, 3. That's it. No, it will go. It is XY question. Correct? So the answer is 3 lakhs. You're getting it? All right. Now next question I'm going. So now again this question is related to your AS10 PPE. All right. So dash less accumulated depreciation is equal to carrying amount. So they are asking about a formula. So now the question here is, what is carrying amount? Guys, what's meant by carrying amount? Remember, carrying amount, you have to study the definition in the AS10. So because AS10 is a huge standard and it has so many definitions. They have given what is meant by revaluation, what is meant by depreciation, what is meant by carrying amount, what is meant by cost, what is meant by purchase cost, installation cost, and what will be included there, decommissioning, and assets held for disposal. So many things, the definitions are there. So I request you to read through the definitions, theoretical part in AS10. All right, because that is more required for you to understand the entire section. You're getting it? And they had defined what is meant by bearer plans, what is meant by equipment, what is meant, when you call something as an asset. So many definitions have been given in AS10 apart from other standards. If you take other standards, it is not that much. Okay, AS9 or AS2 or AS13 or AS11, though it is little big, but not so much definitions again. AS11. So here and all, you don't have so much definitions. But when it comes to AS10, you have lot of definitions which you need to read the theoretical part completely so that you can understand. Otherwise, AS10 is not gonna easy. You're getting it? So now, what is meant by carrying amount? Carrying amount means, what is that value of the asset that is shown in the books? Carrying means what you are showing, what you are carrying in your books. So that's called carrying amount. You're getting it? Now, what would be the formula? It is simple: cost minus depreciation, accumulated. Ma'am, why you use the word accumulated, ma'am? Guys, understand, when you go and see your financial statement, they will say net block of asset, net assets. They use the word what? Net asset. What does it mean? Guys, always they will give the asset. Suppose this information will be there. Asset was purchased, say, in the year 2000 and we keep it as 20. All right. We purchased one land for, say, 10 lakh rupees. The rate of depreciation is, say, 10%. All right. I am following SLM method, which is everything will be, the depreciation remains same for all the years. The amount won't change. So now 2000 original cost would be 10 lakh. So depreciation would be 10 lakh to 1 lakh, 10% to 1 lakh. All right. Now what will happen? Your written down value will come 9 lakhs. Correct. This is 2020. I will be showing the asset as 9 lakh. This is carrying amount. Okay, this is what I will show in my financials. Now 21 I'm standing. Now 10 lakhs, all right. First year I charged 1 lakh, no guys. And second year also I need to charge, no. So total 1 lakh for first year, and second year how much is the depreciation? One more 1 lakh. So totally it is 2 lakh. Now this depreciation 2 lakh is called what? Accumulated. Why it is accumulated? It is from the first year 1 lakh. plus current year 1 lakh. So total depreciation till date, how much I got? So that is called accumulated depreciation. Now what is your carrying amount? 8 lakhs. Now 22 I am standing. Original cost is 10. First year ka 1 lakh, second year ka 1 lakh, third year ka again current year ka 1 lakh. So total 3 lakhs would be my accumulated. So now the carrying amount would be 7 lakhs. If you see my balance sheet will show 7 lakhs. You're getting my point. So remember, so that's the reason we are using the word what? Accumulated. All right. So cost minus depreciation would be your carrying amount. So why I use the word accumulated is whichever year you are seeing, that year you will see the depreciation total depreciation will be taking it and will be minusing it, and final, net as such, net value will be showing it in the balance sheet. You are getting it? So cost minus accumulated depreciation is equal to carrying amount. Next question. Which one of the following is not a non-historical valuation method? Again, this is forming part of your framework and AS2 question, Accounting Standard 2 Inventory. All right. Now, please remember they are asking which one is not a non-historical valuation. Non-historical valuation, the answer is FIFO. All right. Answer is FIFO. There are two methods, which is, they are, no. The question is what? Which one of the following is not a I'm sorry, it's both. Not a non-historical, which means non-historical means you are going to value not on your, like say for example, I purchased these goods on say 1st of April 2022. Now I am standing where? 2023. So how we are going to carry? Are you going to carry 2022 value or are you going to carry the 23 value? You're getting it? So if I carry at 22 ka value, then that is a historical valuation. If I'm carrying, whatever is the recent ones, if I'm taking it, then that is called non-historical valuation. So remember here, they are asking which is not a non-historical valuation. All right. So in this thing, which is not a non-historical valuation. So FIFO is the answer here, because first FIFO and weighted average method forms part of which one? Historical cost method. Why? Because remember, first in, first out. So it will take that value. If I purchase that product on 2022, that will be going out on the same rate. If I purchase that quantity on, purchase that particular lot on 2023, it will be going out at the same rate. You're getting it? So which is not a non-historical valuation method? The answer is FIFO, because FIFO and weighted average cost is forming part of historical cost method. You're getting it? Next one. Which of the following will not be included in effective capital? Remember, this effective capital you will be coming under ratio analysis chapter. Ratio analysis you will be using this. All right. Now, effective capital means there is a formula for that. I have given the formula here. All your equities except the application money pending. All right. All your equities. All right. Plus your securities premium, plus your reserves and surplus, plus your long-term loans. All right. Long-term loans or deposits, whatever it is. All right. Everything. All right. Not short-term. Remember, long-term. Only long-term. So add all those things. Minus if there is any diminution in the value. All right. Please remember, reduced by the aggregate of any investments. All right. Accumulated losses and preliminary expenses. All right. If there is any reduction, permanent reduction in the value, or that investment is scrupulous investment, or that it will not be there, you're getting it. There is some accumulated losses we have in the organization. If any of those things are there, you minus it. Then that answer would be effective capital. Guys, it is nothing but how much paisa I am literally employed in my business. So that is what it talks about. You're getting it? So now which one will not be included in effective capital is paid up capital. Always yes, very much. Long-term loan, yes, very much. Preference capital. Capital though, it is everything, whether it is equity or preference, doesn't matter, everything. Free reserve, of course, yes, because it is my P&L, it is nothing but my general reserve. Revaluation reserve, no, I already told you, revaluation reserve is a notional stuff. It is not realistic reserve or realistic revenue which you have realized. No, because it is just a valuation ka differences. That's it. So earlier I purchased that building for 10 lakhs. Now the value is say 50 lakhs. So there is an incremental in the value to an extent of 40. So I'm just parking that 40 lakhs as a reserve. It is not that really I earned that. Really that reserve is there. No, it is not realized. Remember that until I say sell that land, I'm not going to realize any of those. You're getting it? So that's the reason revaluation reserve is not part of your effective capital. It is just a mere entry which is required for your valuation purposes. When you are evaluating again your assets, at that time if there is any increase or decrease in the value of the asset, that will be parked under this particular reserve. That's it. So it is not forming part of your effective capital. You're getting it? Next question. X Limited, again it is related to your PPE. X Limited has an item under PPE whose purchase price is 1 lakh. And the date of revaluation, the AD is accumulated depreciation is 40,000. So my carrying amount is what? 60. My carrying amount is what? 60K. Remember? Now next what they are saying, my fair value of the same on the date of revaluation is 75,000. Now what happens? 75,000 is a revaluation figure, right? Now what will happen? Now I have to bring my asset to 75,000. All right, it will be valued up. So now would you valuing it as would you compare it at 1 lakh or would you compare it with 60,000? I will compare it with 60,000 because carrying amount is 60, na? Carrying amount is what? 60. So now what happens? 75 minus 60, it would be 15,000 is the incremental, right? 15,000 would be the incremental. Now what will happen? So here there is an, we will see the question now. Asset account, because guys understand, my asset has been increased to an extent of 15,000. So if I want to increase my asset, what I should do? I have to debit it. This thing I've explained in the first class. So debit the asset account to an extent of how much? 15,000. Correct? I'll be doing it, right? So the answer would be which one? A, B, C. Ma'am, then asset account credit is 40,000. No, then why it is? I just reduced it. Why? Because for the accumulated depreciation. That's it. So carrying amount only I have to compare. Correct, na? Carrying amount I have to compare. Why? Because you cannot compare it with the cost. Because on the date of revaluation, my depreciation is coming around how much? 40K. So now what will happen? First asset account will be there 1 lakh rupees. It is there. From there I will reduce my 40K. So I will bring my asset to the original carrying amount. For this I will compare my fair value. My fair value says it is 75K. So there is an upward revaluation to an extent of 15,000. So now what I have to do? I have to increase my asset by 15,000 so that my asset will come back to 75. You're getting it? So what impact you will be giving? I will be debiting to an extent of 15,000 and I will be crediting the depreciation to an extent of 40K. So now 1 lakh minus 40 plus 15 if you do, it will be coming at 75K as your carrying amount. You are getting it? Alright, here I combined both the depreciation and the revaluation figure, guys. If they ask only, usually they'll ask only the revaluation stuff. So your answer ends here itself. Alright, since you need to know the depreciation thing, I just combined both the stuff. Remember, if the question is about revaluation, you can stop it here. If the question is about carrying amount, then you need to say 1 lakh minus 40 I have to do. So that's the reason I'm crediting the asset. You are remembering two concepts I have combined in this question. You are getting it? Next. Depreciation will cease only when? Again, this is related to AS10 PPE. Again, this goes with your definition part. So AS10 clearly mentioned when will you stop depreciating an asset. They have told that if the asset is held for sale, which means the asset is no more in use, we are going to sell it, sell it, we don't want it. When I do that, or when that asset we don't want it in our books, we just remove that. You're getting it? And the asset has become absolutely, what can I say, useless. then in that, only in these cases, I will stop charging depreciation. Otherwise, whether the asset is idle, whether it is used or not, it doesn't matter. I will be keep on charging depreciation. You're getting it? Whether the asset is, ma'am, it is not used to that extent, still I need to charge depreciation? Of course, yes, because it is very much in your books, you have to charge it. Unless until you say that this asset is not at all useful, I am going to sell it. This asset has been kept aside. All right. At that point, and I don't want this asset in my books, I'm just going to strike it out. Then in these two scenarios, I will not be charging depreciation. I'll stop charging depreciation. So the answer here is asset is derecognized and asset is classified as held for sale. So both B and C would be your answer. Here is the definition I have given. Please go through the definition here. Remember, depreciation of an asset ceases at the earlier of date of that asset is classified as held for sale. All right, or the date that asset is derecognized. You are getting it only in these two scenarios. Therefore, depreciation does not cease when the asset become idle or is retired from active use unless the asset is fully depreciated. You are getting it? Remember that. Again, this is a definition oriented question. All right. Now, next question is also from PPE. Ma'am, why you have given so many questions on PPE? Since PPE is very big standard, that's the reason I have given like this. Asset value is 50K. Depreciation charged under SLM is 4,500 per annum. So, life of the asset is 10 years. Then what is the residual value? Guys, what is the formula for depreciation? This we have seen already. So, depreciation formula is nothing but cost of the asset minus residual value divided by useful life of the asset. Correct, na? So, cost is how much? 50,000 in this question. Residual value I don't know. So, let me keep it RV. Useful life is 10 years. And depreciation they have given is equal to how much? 4,500. Now what will happen? 45,000. This 10 will go this side, multiply. So 45,000 is equal to 50,000 minus RV. Correct? Now RV will come this side. 45,000 will go this side. So RV residual value is equal to 50,000 minus 45. This would be 5,000. Your residual value would be how much? 5,000. It is like XY sum. So your answer is B. Alright, it's a formula oriented. So depreciation is cost minus residual value divided by useful life of the asset. This is the formula. By using this formula, you can find out your answer. You're getting it? Next question. Again, this is related to PPE. If revaluation of any asset has to be done, then it has to be on. Again, this I have mentioned earlier. Guys, if you are doing revaluation for any of your asset class, then please remember it has to be carried out on an entirety basis, which means suppose if I have 4 factory buildings, I have 3 office buildings. I'm going to revalue only factory buildings, means then you have to revalue all the 4. You cannot say, no, I will revalue only Mumbai ka factory building. I won't revalue Bangalore. I won't revalue Chennai. No, that won't happen. You have to revalue all 4. You are getting it? So which means factory building is one class of property. In that class, in that set, you have 4 buildings. So all the 4 buildings you should revalue. It is not that only one I will revalue. No. So the answer is entire asset class to which the revaluation asset belong. So it will be, revaluation will be based on entire asset class. Say for example, again, suppose I have machineries. Under that I have vehicles, I have, other production machineries. I'm going to revalue only production. So under production, I have 10 machineries. You have to revalue all the 10 machineries. You cannot just do only one machinery revaluation and other 9 machineries on their original cost. No ways. So remember, entire asset class, entire asset subset should be revalued. You're getting it? If you are going to revalue, please do it in that way. Don't revalue only one item. You're getting it? Next one. How many types of currency are there as per accounting standard for Forex? Alright, this is again AS11. There are 3 currencies basically. Foreign currency, functional currency, and presentation currency. Foreign currency means other than your home currency. That is called foreign currency. Say for example, in India, the foreign currency would be other than INR, anything that is there, that is foreign currency. Functional currency means at which currency you are operating. You're getting it? Operating, or your operations, like, you know, you are billing in which currency, you are operating in which currency. Suppose that is called functional currency. Suppose I bill it in dollars, USD means, then that is a functional currency. You're getting it? I bill it in USD, I purchase it in USD means that is a functional currency. Presentation currency, in what currency you are going to report your financial statement, you are disclose your financial statement, you are present your financial statements, prepare your financial statement. That is called presentation currency. In India, the presentation currency is INR. You're getting it? So basically there are three types of currencies as per AS 11. So foreign, functional, and presentation currencies. All right, this is again definition oriented question. Now, non-monetary item which are measured at fair value in foreign currency. Remember, non-monetary item which are measured at fair value in foreign currency. So which means there was a revaluation happened. So it is a non-monetary item first thing, and there was a revaluation happened. All right, and it is in the foreign currency. All right, and it will be translated at dash during subsequent measurement. So now when you are translating into INR, or, you know, reporting currency, what rate you will take? That is the question. Usually non-monetary item will be translated at their historical rate. All right, it will their rate of a transaction, whatever the date the transaction has happened, that rate only they will be doing it. Whichever year you are reporting it, you know, that non-monetary item happened in the year 2020. At that time the currency rate was 70, though today also I will be reporting at only 70 rupees. I won't report it at 85 rupees or 83 rupees. No, because it's a non-monetary item. So non-monetary item will be translated at the historical cost rate, exchange rate. You're getting it? Whenever I'm doing the translation. Translation means converting to INR. Now here the question, what happened? The non-monetary item has been revalued at some point. Now what rate you will be taking? Again, it's a definition oriented question. AS 11 clearly says that when a non-monetary item undergoes revaluation, so the translation should happen in the subsequent, the upcoming years. The translation should happen at the revaluation date ka exchange rate. You are getting it? So the answer is, it will be translated at exchange rate at the date of valuation. Remember, usually it will be translated at the historical rate. That is, whichever date the transaction was happened. Say for example, I purchased an asset, all right, in the year 2020, say say it is for $10,000. Okay, 10K. At that rate, at that day, it was purchased on, say, 1st April 2020. So on that date, the $1 is equal to, say, 70 rupees. Now in my books in India, how would I have recorded here is 10,000 into 70. All right. Correct, no? 7 lakhs. 10,000 only I have written, no? And this is 10,000. Right? So 7 lakhs. Now this is on 31st March 2021. I reported 7 lakhs. Now 22 also I will be reporting it at 7 lakhs. I don't change. 23, what happened? I did the valuation for this particular asset. Now the revalued figure was around, say, 1.2 lakhs. Okay. Now what is the rate, guys? Now 1.2 lakhs. I did the revaluation on, say, 15th, which date I will take? This is 31st March 2022. This is 31st March 2023. So I'll take 15th June of 2022. I just revalued and it came to 1.2 lakh dollars. On that day, June 15th, the US dollar was $1 is equal to, we'll keep it simple, it is around 80 rupees. Now what rate you will translate here? You will show it in 7 lakhs or more than 7. It will be 1.2 lakh into 80, whatever the rate it was revalued, na? It is revalued, right? On the date of valuation, what was it? 80. So on this rate, I will be taking it. This rate, I will be taking it. You are getting it? Valuation. I have taken it in valuation. You are getting it? If I measure it in fair value, though, then whatever the date of valuation, whatever the exchange rate, I will consider that. I will be showing it here. You are getting it? Here I talked about revaluation. Usually it will be a fair value. Suppose if I'm taking that non-monetary item at the fair value, though, then whatever the rate on the date of valuation, you consider that rate. Don't go for your exchange rate. You are getting it? Next one. X Limited issued bonus shares in the ratio of 1:2. Alright. Total outstanding shares were 10,000 at rupees 10. Then the bonus entry would be what? Remember, this bonus shares won't result in any cash flow. So this is just for your face value information. That's it. All right. Now what happens? 1:2. So for every one share, they'll be giving you what? 1:2, na? 1:2. So for every 2 shares, they'll be giving you 1 share, right? So now what happens? 10,000 shares are there. Right, 1:2. So for every 2, 1 share I will be issuing. So 10,000 shares totally are there. How much shares I would have issued at a bonus? 5,000 shares I would have issued at a bonus. All right. Now what will happen? How I will pass the journal entry? Guys, since there is no cash inflow here, obviously bonus shares will be issued at free of cost to the shareholders. From where I will give it? I can give it from general reserve or securities premium, or free reserve, whatever it is. There are a set of items, right? Now general reserve account will be debited to share capital account. Okay, now how much? 5,000 is the number of shares. So what is the face value? 50,000 rupees. So general reserve will be debited to an extent of 50. Share capital account will be credited to an extent of 50. Ma'am, why are you debiting general reserve? I'm capitalizing the profits. I'm capitalizing the free reserve, which means from the reserve, I am taking 50,000 worth of share cap, 50,000 worth. I'm giving it to the shareholders, so that 50,000 is going to my share capital account. That's it. This is the logic behind it. So share capital account will be credited to an extent of 50 and general reserve will be debited to an extent of 50. This is again related to your bonus shares and basics of issue of shares. In these chapters, this question will be covered. All right. Next, when calls in arrears will be opened. Again, this is related to your basics of issue of shares. Guys, understand, calls means what? Say for example, suppose if your face value is face value is 10 and issue price is also same thing. Some companies, they will collect entire 10 rupees at the time of application itself. They'll say you pay me at one stretch. Few companies, they'll say no, I have some 4 ways. At the time of applying, you just pay me 2 rupees. All right. At the time of allotment, when I'm giving you the shares, you give me 3 rupees. That is sufficient now. Then whenever I wanted, I will ask you. So whenever I'm asking, that is called calls. Calls made by the company. Now first call, second call, third call will be there. Now I will say I will be collecting the remaining amount in 2 installments. Maybe 2.5 rupees, 2.5 rupees I may collect. Call 1, call 2. Alright. Now what happened? Whenever the company is making the call, they'll say, Baba, come and pay that Baki 2.5 I wanted now. Could you please come and pay? Suppose if the shareholder couldn't make the payment within the due date, whatever they say, then that is called calls in arrears. They couldn't make. Shareholders couldn't make the payment when the amount was called in by the company. So that is called calls in arrears. You're getting it? So calls have been made, but it is not paid, but shareholder couldn't make the payment. So that is called, ma'am, calls, they didn't do the calls only, they didn't ask only, ma'am. Then there is no point, there is no question of calls in arrears. You're getting it? Unless when the company calls for it, the company says, Baba, please come and give me the 2.5, I'm really in need of it. You give me that now. Then yes, the company has made the call. Now the shareholder is supposed to pay. If the shareholder couldn't make the payment, then that is called calls in arrears. So the answer is A, I believe. So with this, I'll wind up today, guys. I think we have seen so many questions, I guess. Still, I have few more questions to go. That's okay. Next class we can see. All right. So I'll see you on the next class. We will see some concepts, a few questions on the next class, and then I'll go with the concepts. All right. So again, once again, I'm just telling you there is some offer going on in your Oliveboard. So kindly make use of it. So I'll see you on the next class, guys. I wish you all the best tomorrow. Have a